Hello and welcome to Financial Secrets Revealed Season 3, where we meet the experts. Today I am joined by Chris Joye. He co-founded Coolabah Capital in 2011, which today runs over $8 billion in the fixed income market space. He's been called an alpha manager, which sounds very, very snazzy. And you've worked everywhere, Chris, from Goldman Sachs in London and Sydney to the RBA. Welcome to the show.
Thank you very much for having me, Amanda.
I think you definitely meet the team title of expert. So you have been everywhere and done everything. Can you give us a quick overview about your career, how you got started in financial services and why you're still there?
Yeah, sure. I studied at Sydney University, was lucky enough to win the University Medal in Economics and Finance there. And funnily enough, Malcolm Turnbull was chairman of Goldman Sachs at the time, and he hired me in to Goldman. I worked in mergers and acquisitions and principal investments, studying in London, came back to Australia with Goldman, worked in Sydney, got a scholarship to study for a PhD at Cambridge University. Whilst I was waiting to start there, I did some time at the RBA, ran an inquiry into housing for Prime Minister John Howard at the time as well, and published a long report on that subject, and have always been engaged in policy, so public policy, idea generation, have always written for newspapers on ideas for the last, 20 odd years. And then whilst I was at Cambridge, a friend of mine suggested we set up a quant research and investment business, which we did, and it specialized in securitized, complex, structured fixed income products. And I sold that to Macquarie Bank in 2010 and set up Coolabah in 2011. As now we are actually running 10 to 11 billion in FUM. So I have 44 executives, 11 traders who work for me around the world in London, Sydney, Melbourne, and Auckland, and 16 analysts. Wow. We buy and sell about $700 million of bonds each day on average. And we use 80 proprietary bond pricing models to figure out what bonds are cheap and what bonds are expensive. That's what I do.
So for those who don't have a deep and meaningful understanding of the bond market, without using jargon, what's it all about?
Yeah, so maybe the best way to explain it is to think about buying a home. You put down a deposit, that's called your equity. You take out a loan, that's debt. And so you're funding that home with maybe a 10% equity deposit and a 90% mortgage. Companies also fund themselves with equity and debt. So as an example, CBA, rough numbers, has about 10% equity and 90% debt. That's what the Commonwealth Bank uses as its funding. And the debt that it borrows is a combination of deposits. So that's typically an overnight loan, in the sense that when you invest in a deposit, a bank pays you interest, and it is borrowing money from you, and then it will turn that money that you give them as a deposit into a loan. But they also issue other forms of debt. So they actually have many different types: senior bonds, subordinated bonds, hybrids that are part debt, part equity. And our job is to find the bonds that companies issue and that governments issue that are cheap, that are likely to appreciate in price, very much like a stock picker in equities. So, if you're a value investor, you might look for companies that are cheap, that have very high dividend yields, but low prices. And in the same way, in the bond market, we're using 80 statistical models, typically 20 to 30 models per bond, to find bonds that are paying too much interest for their risk. And ideally, the bond price goes up and the interest rate goes down and hits our fair value target, and we sell it.
Easy. Sort of. A lot of analysis behind the scenes, I'm sure, to get it right.
Yeah, and maybe just a little further elaboration, in the last 12 months, we run a range of strategies, but we run what some might call cash enhanced funds that have done, probably 7 to 8% depending on the currency, because we offer Aussie dollar, US dollar, and New Zealand dollar solutions. So those cash enhanced funds are our lowest risk products, but you might be looking at term deposits or other low risk investments, and they're a solution. And by finding cheap bonds that are paying too much interest and capturing that price appreciation, we can improve the returns. But we have other strategies like a long short credit fund that I believe has done about 13 to 14% after fees over the last 12 months. And that's a more aggressive strategy that can use leverage, that has higher yield, that invests globally. And actually, I'll just check the exact return because I don't want to misquote that number. Yeah, 13.8% net of fees.
Nice.
And that portfolio is made up of bonds that typically have an A+ credit rating. What does that mean? The same credit rating as Macquarie Bank, because it has an A+ rating. But we can use leverage to enhance the returns, and that also increases the return volatility.
So back as a very new advisor, when I was doing my studies and went through Deakin University and then did my master's, fixed income was sort of more about an enhanced cash rate. So you were hoping for 4 or 5%, 13's knocking it out of the park, 8 or 9's fabulous. So it's now in a space where it's competing with equities, but we were always taught, when the cash rate goes down and bonds go up, and it's inverse, and they're this hedging against equity markets falling over, and this is where they fit in a portfolio. It seems everything's changed, Chris. All those rules we were taught as hard and fast things when it comes to fixed income and bonds seem to have gone out the window. Can you sort of talk through why it's a whole new world with bonds?
Yeah, because basically you can get two types of bond portfolios: a floating rate portfolio, which is very similar to a variable rate bank deposit, and then a fixed rate bond portfolio, which is very similar to a long-term fixed rate term deposit. And they have different functions. If you've got a savings account at a bank and the interest rate on that account goes up and down with the RBA cash rate, well, those savings accounts in 2021 were probably paying nothing because the RBA cash rate was 0.1%. But today the RBA cash rate is 4.35%. So those variable rate savings accounts are probably paying 4.5 to 5. And equally, you can find a fixed rate long-term term deposit that will pay even higher returns again. However, they have different risk profiles. So the variable rate savings account will do well when interest rates rise, and it will do less well when interest rates fall because its interest rate will just go up and down with the RBA cash rate. The fixed rate term deposit kind of does the opposite. So when interest rates rise, if you've locked into a 5-year term deposit, you suffer because there are now new TDs out there that offer higher rates and you've locked into a lower rate. Conversely, if interest rates were to plummet back to zero again and you've locked in a TD paying 5.5%, happy days, because now TDs, as in 2021, are only paying 0.5% and you locked in 5.5%. It's the same with bond portfolios. So there are floating rate bonds, exactly the same as a variable rate savings account, and they will do really well in a rising rate climate. And there are fixed rate bond portfolios that do really well when interest rates come down. Our floating rate, our most aggressive floating rate strategies were probably yielding, as in paying an average interest rate of about 2 to 3% back in 2021. Today, our most aggressive, like our floating rate high yield fund, is paying 8% as a gross cash running yield. So that's done really well. Conversely, fixed rate bonds did really badly when the RBA lifted rates in 2022. In fact, the benchmark in Australia, which is called the Composite Bond Index, it's a fixed rate bond portfolio, not floating rate. That fell, I think, peaked to trough about 13 percentage points in 22 as cash rates rose and long-term interest rates rose. Now, of course, interest rates are very high. So people are looking at fixing those interest rates, much like you might at TD. Now, you and I are old enough to remember. I'm obviously much older than you, Amanda, but back in 2000,
Sadly, I don't think so.
back in 2008, you could get 5-year term deposits issued by the big four banks, paying 8%.
Nice.
And if you locked them in, you made out like a bandit. And that's the sort of trade that some people are looking at now. Do I lock in my interest rates? Because interest rates have risen a long way. At some point, they should start falling again, and they want to pick that peak. But there's no doubt the bonds are the new black, and that bond portfolios are paying very attractive yields. And, the best bond managers are returning 13 to 14% after fees over the last 12 months to March, if they've done a good job.
So on the subject of interest rates, at the start of the year, all the talk was, look, we've peaked, the interest rates are as high as they're going to get, our mortgages are going to start coming back down again. We had all these rises, we've got inflation under control. Look for your mortgage to start getting, cut back down those rates again. Do you think that's still going to happen? Is it going to be as fabulous as we want it to be? It seems the talk's gone very quiet on that front. What do you think is going to happen?
Well, we never told people that interest rates were going to come crashing down. We've argued very consistently since 2021 that interest rates are going a lot higher than people think and the markets think. Our analysts were telling us internally in December 21 that the US Federal Reserve needed to lift its cash rate to 5 to 6%. At the time, it was at 0.25%. Now it's at 5.25 to 5.5%. Our analysts were also saying that the RBA needed to go to 4 to 5%. At the time, it was 0.1%. Now it's 4.35%. Markets get this stuff consistently wrong. Back in December 21, the market was saying that the peak in the US Federal Reserve's cash rate would only be 1%. Totally wrong. Last year, as you've intimated, the market at various points was telling us that the Federal Reserve was going to cut rates by a full percentage point or 100 basis points last year. Of course, it never happened. We said, no, rates are going higher and staying higher. At the start of this year, they said the Fed was going to cut by 175 basis points. If you read my AFR column, I've consistently argued that that's not going to happen. The market was saying they were going to start cutting in March. Again, we consistently argued that that would not transpire. Now the Fed is not expected to cut rates until September or October, and it's only currently expected or forecast by markets to cut by about 40 basis points, not the 175 that was penciled in January this year. The problem is we have very sticky and stubborn services inflation, which has been our central case for years. We've long argued this will be a multi-year battle to get inflation back to the central bank's typical 2% target. That sticky services inflation is being driven by services businesses' biggest cost, which is people, so therefore wages. Last year, the minimum wage in Australia was increased by 8.6%. Award wages were increased by 5.75%. That affects on our numbers about 25 to 30% of all workers. Wages overall in Australia are growing at about 4 to 5% per annum. But if you adjust wages by productivity, they're growing at about 6.5% per annum because our productivity is so poor. And so we have this problem where unemployment rates globally are very low. So the Aussie unemployment rate is just 3.7%. Historically, it's averaged about 5 to 6. Full employment, which is what central banks are targeting, is considered to be 4 to 5%. In the US, the unemployment rate is just 3.8%, and their long-term averages are very similar to ours. And so we have a problem of excess demand. Economies are growing too quickly, unemployment's too low, wage growth is too high, and consequently services inflation is too high. We have had relief in the form of goods prices coming down as supply chains reopen. So goods prices rose in the pandemic when supply chains were shut. But the central banks got that wrong as well. In 2021, you might remember, Amanda, the central banks all said, this inflation is going to be transitory. It's going to be short run. We won't have to lift rates aggressively. We argued at the time, no, there's not just a supply shock, but also a demand shock. And that demand shock is going to manifest in the form of persistent services inflation. And that's obviously what's materialized. And it's going to be very difficult to get this last mile of inflation under control. And I think the central banks are going to struggle to get inflation sustainably below 3% when wages are running at 4 to 5. We've got potentially wage price spirals, and we've got very poor labour productivity. So this means interest rates in our view are likely to remain high for long, and we're likely to see increasingly more stress across the economy. We think the future is stagflation. We think the canary in the coal mine is New Zealand. In New Zealand, they've got high inflation, high wage growth, but they've actually had negative economic growth because they started hiking interest rates way ahead of most of the rest of the world. Their interest rate is 5.5%. We're at 4.35. Australia actually sticks out like the proverbial, and I apologise for the crude language, but like bull's balls in the sense that we're at 4.35. The New Zealanders are at 5.5. The Brits are at 5.25. The Americans are at 5.25 to 5.5. The Canadians are at 5. We run the RBA's macroeconomic model called the Martin model, and that implies the RBA should also be at 5, but they're rolling the dice with inflation. And I think that's going to give us higher for longer rates. And the risk is that over the next few years, we see sticky inflation combined with high rates, combined with weakening growth, which will be, I think, negative for risk and for assets that don't have much margin for error, like equities, and also negative for anything that's illiquid, like commercial property, private debt, etc.
So with all that cluster going on, not great news for mum and dad mortgage holders that those rates we thought we might get are going to come off. Does all this cluster fluffery mean that it's hard times for business then, and there'll be more business failure rates? And what does that mean in lending then if times are getting tougher with wage growth and cost of living crisis?
Well, we track the number of insolvencies reported by ASIC every month in Australia, and we've seen a huge increase in business failures. Insolvencies are currently running at the highest level in almost a decade, led by construction and hospitality. Before the pandemic, Aussie businesses only owed the Australian Tax Office about 25 billion. Today, they owe more than 50 billion.
Wow.
And the ATO is putting them into administration if they don't pay their debts. We're also seeing that after the global financial crisis, the regulators really clamped down on banks lending to borrowers that didn't have a good chance of repaying their loans. So these are known as subprime borrowers. And those subprime borrowers shifted out of the banking system, and they were picked up and welcomed with open arms by non-banks, particularly after the GFC, because after the GFC, interest rates on savings were very low. And for the period from 2008 to 2021, we had this thing called the search for yield. And you had new asset classes emerge to satisfy the search for yield. One example is private credit. It didn't exist in Australia prior to the GFC. So a private credit fund is basically somebody lending to a subprime corporate or residential property developer or commercial real estate borrower that can't otherwise get a loan from a bank. Now, banks want to lend. They want to grow their balance sheets. They desperately want to lend, but they're not going to lend to borrowers that can't repay their loans. But there are other investors out there that for the right interest rate will. And we're seeing a big increase in stress in private debt portfolios. There are reports of many private credit funds that are under the pump that have liquidity crunches because investors are withdrawing money at the same time borrowers are not repaying loans. And I met with a private credit fund actually last week, and they said that 10% of all their loans had gone sour. We track the proportion of home loans written by non-bank lenders as opposed to bank lenders. So we actually track both. And we track the proportion of those loans that are in default or arrears. And what we've seen is that whilst bank home loan arrears rates are very benign, they've increased a bit as rates have increased, but Amanda, they're kind of like on par with historical averages. There's been a massive spike in non-bank lenders' home loan arrears rates, irrespective of whether we look at the dodgier subprime borrowers or even their best, and they're known as prime borrowers that are meant to be bank-like in quality, but are demonstrably not. So there's this huge gaping chasm between the unregulated non-bank lenders and the regulated banks who are intrinsically very conservative.
Been a long time since Australia's seen some banks fail. So do you think that's in the future then with those non-bank lenders?
Yeah, I think we won't see banks fail. I think we'll definitely see some non-banks fail. I think we'll see a lot of the private credit funds disappear. And we have seen that recessions are generally massive killers of non-banks. You might remember Aussie, Rams and Wizard in the GFC, Pyramid in the 1991 recession. And, on that note, I would make the point, Amanda, with the greatest humility, that this cycle is not over yet. People, the risk junkies, the stock jockeys are talking about soft landings, but we've still got an inflation crisis. People are now talking about the Fed having to hike again. because they've actually seen a re-acceleration in US inflation. We're seeing the same thing in New Zealand and the same thing here in Australia. Services inflation in the United States is running at 6.5% per annum. To get inflation to 2%, it normally has to run at about 3% per annum. And so this cycle is not over. And the reason 2022 and 2023 felt so resilient is that during the pandemic, we had the buildup of enormous cash buffers because we locked down economies and then we gave them unprecedented amounts of cash. So through fiscal policy, we gave people loads of cash. And in the US, that was actually equivalent to about 2 years of extra economic growth that consumers spent in 22, 23. But those excess savings have now disappeared. They've been exhausted. In Europe, they were worth about 1.5 years of extra economic growth. In Australia, where we had harsher lockdowns and even more generous fiscal policy in some respects, our cash buffers are worth about 3 years of economic growth. And this is forestalling the impact of tighter monetary policy and higher interest rates. And it's likely elongating the cycle. So I still think we'll see recessions. New Zealand's in recession, the UK's in recession, and we're seeing cracks starting to appear. Global corporate defaults this year have been amongst the worst we've seen since 2009. US bankruptcies last year were the second worst since 2010. As I mentioned, Aussie insolvency is the highest in a decade.
Wow. Some pain still ahead then. Not the great news that people had wanted to hear, I suppose. Another thing that our government's talking about is reducing immigration. And I know immigration's a hot topic for a lot of people, but many countries aren't growing anymore without it. The population is actually collapsing based on birth rates rather than immigration. And if Labor does reduce the immigration into Australia, obviously that will impact a lot of other things. And real estate pricing can be one of those things that's impacted. Do you see a big correlation there and have any expectations about where that will go if immigration is cut for Australia?
We expected a tsunami of migrants once the borders opened. We actually forecast that. We also forecast a decline in house prices in October 2021, assuming the RBA aggressively lifted interest rates. We thought house prices would fall 15 to 25%. They fell 10%, peak to trough, which was the second biggest decline in 40 years. Inflation adjusted, they fell 15%. They didn't fall quite as far as we expected, and they definitely bounced back much more quickly than we anticipated in 2023. That was, with the benefit of hindsight, driven by this incredible population growth. So Australia's been running some of the strongest population growth in the developed world at north of 3.5% a year. And I think what surprised us was how well heeled or moneyed the migrants were. So, you can see stories in Sydney in affluent suburbs like Bellevue Hill where 1,000 square metre blocks of land with a home on it are selling for like $35, $40 million to Chinese and Vietnamese buyers. And there's actually quite a lot of Vietnamese money coming into Australia because as supply chains have shifted from China to Vietnam, they've obviously made out like bandits. So I think, notwithstanding the talk of pulling back on migration, Australia's always run consistently strong population growth. Over the last 30 years, we've had one of the strongest rates of population growth in the developed world. We are an immigrant nation. About 30% of us were not born here, who currently live here, and about 1 in 2 Australians have a parent born overseas. So immigration is a good thing in the long term in terms of supporting labour supply and driving productivity and entrepreneurship and bringing a lot of energy into the country. However, it is a net demand shock in the short term. So in the short term, all that money coming into the country is kind of fueling inflation, and it's pushing house prices higher. House prices do look very expensive. I do think there are pockets of relative value. I like Perth resi property; looks very cheap. I love the Sunshine Coast, particularly Peregian Beach is very, very cheap. Some people are calling it the new Noosa. Nice. I will disclose that I bought a property in Peregian, so I'm completely
fair enough. Full disclosure.
Yeah, but obviously there are other markets that look heinously expensive.
I think in Queensland, what we've seen is, we've had this mass influx of the Mexicans from south of the border coming into, our capital cities and surrounds. And a lot of those in the Gold Coast and Sunshine Coast are then moving further into the rural areas up in far north Queensland. So there's there's certainly an interesting flux. A girlfriend of mine who runs 3 real estate places north of the Sunshine Coast. Most of their buyers are Queenslanders looking to relocate into more country areas as more sort of the influx comes into the beautiful places, the Noosas and the Brisbanes and Goldies. So
I think Noosa is super expensive. I think the south of Noosa and the Sunshine Coast is actually really cheap. And of course, Queensland is a great state. Queensland owns all of its infrastructure. Other states have sold off a lot of their infrastructure. We've got the 2032 Brisbane Olympics, which, in contrast to our Victorian brethren, we're unlikely to lose. In obviously respect of the Commonwealth Games. There's a lot of additional infrastructure planned for Queensland and the Sunshine Coast in particular. The weather is incredible. It's warm all year round. There's an international airport in Maroochydore, which is impressive. So yeah, it has a lot of attractive features, and we were definitely one of those Mexicans climbing north during COVID in exile for a period there. But I love Queensland.
Oh, look, really, I'm born and bred Queenslander, 4th generation, so I'm sold. What's not to love? There's actually not too many, so I'm very proud of that. The Olympics, going back to that, we've talked about how in the past on different shows that Olympics themselves don't actually mean, that the Queensland economy is going to thrive, but you touched on that infrastructure spend, and it feels like as a Queenslander, our infrastructure is so far behind the times because of the constant and massive, growth of population that we've had, that it just can't keep up. And, if you've ever had to do the M1 commute between either the Sunshine Coast and Gold Coast going into Brisbane, it certainly feels that what should be, less than an hour run now can take 1.5 to 2 hours. This lead up we've got now in the next 8 years to the Games, will that infrastructure make a big difference? What can Queensland see? And, is there ways investors can pick up on and, learn from and grow their own assets with this, infrastructure build coming?
Australian states have a mega infrastructure pipeline that's been planned for some time now. Queensland also has huge infrastructure commitments. There's rail planned for the Sunshine Coast, which I think will break some of those bottlenecks. And I think you'll see Queensland, because it's such a rich state, it's got those coal royalties, it kind of runs a quasi-budget surplus in contrast to the relatively financially poorer states like New South Wales and Victoria. Victoria's running massive budget deficits and doesn't own a lot of its infrastructure. Queensland has the free option of privatising infrastructure if it wants to, but its revenue generation is very, very strong. And I'd be super surprised if we don't see ongoing infrastructure investment. It is remarkable. I mean, if you travel around Sydney, the tunnel network is just extraordinary with the M8, the M5, the Cross-City Tunnel. They've got the new Sydney Metro going in, which is amazing, and the light rail. So Australian infrastructure is world-class, led by our extraordinary superannuation system, which kind of drove a lot of the demand for infrastructure exposures. I certainly think that there are the residential property investment opportunities to be captured for folks if they can think intelligently about the future rollout of infrastructure and how that will change the complexion of demand for resi property.
Well, he's hoping, as just a Queenslander, that the traffic improves with all the spend. So thank you so much, Chris, for sharing that. Just one last thing. You also touched on the private debt and how that'll work out in credit funds. There seems to be an influx of, fund providers offering these style of funds going forward, but you haven't been super positive about them. So you think it's an investor beware with these new funds that are popping up in that space? I don't think I get a day goes by now without some fund manager coming to me going, come to our lunch on our new private credit or private debt fund. So where's that going?
Yeah, there's been an extraordinary explosion in private credit funds. Most of them are run by two men and a dog. There are exceptions, like groups like Metrics have 125 executives, very well resourced. So I don't want to cast aspersions against the entire industry, but the reality is this industry did not exist before the GFC. This industry has never really managed credit through a default cycle. And that's partly a function of the fact that we haven't actually had a proper default cycle in Australia since the 91 recession. So the skill set doesn't exist. These guys are lending to subprime borrowers. There's a lot of pain already in these portfolios, despite the fact that the Aussie economy is so resilient. The Aussie economy is only going to experience more duress as rates remain high for long and our excess savings buffers get ineluctably or invariably depleted. And I think people need to understand these portfolios are completely illiquid. So these loans have no liquidity at all. They're completely unregulated, unlike a bank, where APRA is constantly breathing down the necks of the bankers to make sure they're lending prudently. And think about all the regulatory scandals we've had with banks over the years, imprudently lending, all the dramas in 1991, the last recession we really had, proper recession. ANZ and Westpac almost went under because of their commercial real estate and their residential property development exposures. What's fascinating about Australia is all our private credit funds are chock-a block full of commercial property loans and residential property development loans. If you speak to the banking regulator, APRA, they will tell you the one or the two sectors that are absolute bank killers are resi property developers and commercial real estate. If you go offshore and look at the private credit funds overseas, they've been around for decades. They've been through cycles. They've run portfolios that have experienced a lot of stress. But most importantly, they tend to have very little in the way of real estate exposures. So I think this is a disaster waiting to happen.
Oh, great. Great stuff for investors to keep in mind for sure. Thank you so much for sharing your wisdom with us today. It's been great having you on the show, Chris. We really appreciate it.
Thanks, Nana. Appreciate it.
Take care.